What if I told you that one of the most boring stocks on the market is quietly outperforming some of the hottest sectors out there? While everyone is chasing AI, crypto, and high-growth tech, ExxonMobil, yes, an oil company, has delivered over 40% growth in the past year, and right now, it's sitting at a very interesting point. The big question is simple. Is this the end of the move, or is Exxon getting ready for another breakout? Today, we're going to break it all down: the price action, the fundamentals, the risks, and what could happen next. Let's start with what's happening right now. ExxonMobil is trading around $149 per share, slightly up in pre-market. At first glance, nothing too exciting, but when you zoom out, the picture changes completely. Over the past year, the stock is up more than 40%. Over the last 6 months, it gained around 30%. But in the short term, we're seeing a pullback, about 5% down over the past month and around 4% this week. This tells us something important. This is not a weak stock. This is a strong stock that ran hard, and now it's taking a pause. And in the market, strong stocks don't usually collapse immediately after a run. They consolidate, they slow down, they build a base. That's exactly what Exxon is doing right now. Now let's talk about the chart. Recently, the price pushed up toward the 150 level, which is acting as a clear resistance. It got rejected slightly and is now moving sideways in a tight range between roughly 148 and 150. This type of behavior is called compression, and compression usually leads to expansion, meaning a bigger move is coming. Right now, we have two key levels. Support sits around $148, resistance is right around 150. If the stock breaks above 150 with strong volume, we could see continuation to the upside and potentially new highs. But if it drops below 148, we may see a pullback toward 145 or even 140. So this is not a moment to blindly jump in. This is a decision zone where the market is choosing direction. Now let's zoom out and ask a more important question. Why is Exxon even performing this well in the first place? The answer is simple: cash. ExxonMobil is one of the strongest cash-generating machines in the entire market. It makes money from oil production, natural gas, refining, and global energy operations. And unlike many growth companies, Exxon produces real, consistent free cash flow. That cash flow allows the company to do three critical things: pay dividends, buy back shares, and reinvest into its business. And speaking of dividends, this is one of Exxon's biggest strengths. Investors love this company because it consistently pays them. It's not just about price appreciation, it's about income. In a world where many stocks promise future growth, Exxon delivers present cash. But there's one factor that matters more than anything else here: oil. Exxon's performance isn't a primo tied to oil prices. When oil goes up, Exxon makes more money. When oil drops, profits shrink quickly. So what's happening with oil right now? Global demand remains strong, especially from developing economies. At the same time, supply is not unlimited, and geopolitical tensions continue to create uncertainty. All of this supports relatively high oil prices, which is good for Exxon. But this is also where the risk comes in, because if oil suddenly drops, Exxon will feel it immediately. And that brings us to the risks. First, oil price volatility. This is the biggest one. Second, the global shift toward renewable energy. It's slow, but it's happening, and over time, it could reduce demand for fossil fuels. Third, regulatory pressure. Governments around the world are increasing scrutiny on energy companies. And finally, valuation risk. After a 40% run, some investors are starting to wonder if most of the good news is already priced in. That doesn't mean the stock can't go higher. It just means expectations are higher now. So what happens next? Let's look at both scenarios. In the bullish case, oil prices stay strong, Exxon continues generating massive cash flow, and the stock breaks above 150. That could open the door for further upside and new highs. In the bearish case, oil weakens, the stock loses support at 148, and we see a deeper pullback toward 140 or lower. So what should you do as an investor or trader? If you're a long-term investor, Exxon still looks like a solid, stable company with strong cash flow and reliable dividends. It can make sense as a hold or even a gradual accumulation on dips. If you're a short-term trader, this is all about levels. You wait for confirmation, either a breakout above resistance or a breakdown below support. Right now, this is not a clear buy or sell signal. This is a setup, and setups are where the biggest opportunities come from, but only if you stay patient. So is ExxonMobil still a buy? The real answer is, it depends on your strategy. But one thing is clear: this boring energy giant is still very much alive in today's market, and the next move could be bigger than most people expect. Now, I'm curious, would you buy Exxon at this level, or would you wait for a pullback? Let me know your thoughts. You can stand under my